So in this chapter, we've been going through a review of financial statements. And the last financial statement that we're going to have a look at is the statement of cash flows. And because cash is so important in finance, this is one of the more important statements that we're going to have a look at. If you look at it, you'll see that it's split into sections: operating activities, investing activities, and financing activities. We're going to use the three statements that are in your notes, balance sheet and two income statements year over year. Let's try that again. An income statement and two balance sheets in sequential years. And using those statements, we're going to create a statement of cash flows using the indirect method. Oftentimes, we're not going to have enough information to use the direct method. And in this class, we'll never have enough information to use the direct method. So it'll always be the indirect method. So we go to our income statement first, and we get the net income. So our net income, or earnings after taxes, was $157,500. The next thing that we do is we add back in non-cash expenses, and there's one that dominates, and that's amortization. In this case, we do have amortization. So if we go back and we look at our income statement, you'll see that there's $50,000 in amortization. So that gives us $207,500 cash flow from operations. Now, things happen during the growth of your company mostly, and those things may require extra money. So as our company grows, we should see a spontaneous increase in accounts receivable and inventory, and we have to finance that from somewhere. So we're going to need money to lend more credit to our customers and to purchase more inventory. So let's go look at the two balance sheets and compare them. So if we look at our accounts receivable, we see that it's increased by $30,000. Hasn't done that. We see that it's increased by $30,000. There we go. And if we look at our inventory, we see that it's increased by $20,000. Both of those things are increases in assets, and we need to pay for that somehow. So we've spent $50,000 more on assets. That's actually a use of cash. So it's going to decrease the cash we would otherwise have available. So our accounts receivable results in a use of $30,000 in cash, and our inventory results in a use of $20,000 in cash. Go back and have a look at our balance sheets, and we see that on the balance sheet there's some prepaid expenses. Those prepaid expenses actually decrease. So we've recorded them as expenses, they've decreased our income, but we didn't spend cash on them because they were prepaid. So we're going to add back in this $10,000. And now we go and look at the liability side. As our company grows, so does the amount that our suppliers lend us, so our accounts payable are going to increase. And that's called spontaneous financing. So let's go have a look and see what's happened to our accounts payable. So our accounts payable have increased by $35,000. That's money actually lent to us by our suppliers. Our accrued expenses, which are expenses we haven't paid for yet, have decreased by $5,000. So this means that we've actually paid out $5,000 more in cash than we've declared in expenses. So that's actually going to be less cash than we would have otherwise. Just pretty that up by doing that. Beautiful. So we see that the net effect in non-cash working capital, our current assets and current liabilities, is a decrease of $10,000 in our cash. So our cash provided for in operating activities is $197,500. Now, we made some investments. Some of these investments were actually in investments, and those would probably be securities, things like stocks or a portfolio investment in other companies. And we invested in our main business, our plant and equipment. Those are going to be uses of cash. We're going to have to come up with a way to pay for those things. So every time your assets go up, remember you have to pay for it somehow. So let's go have a look at our balance sheet again. And we go and we look at our investments, and we invested another $30,000. We've got to pay for that somehow. It's a use of cash. There, we invested another $30,000. We look at the book value for our capital asset. We're not so worried about the amortization because remember, we're just taking amortization out. But the increase of $100,000 in the book value tells us that we made an extra investment of $100,000. Let's put those two numbers in. They're both uses of cash. We're going to need to find a way to get this cash. So $30,000 for the investments and $100,000 for the extra plant and equipment. And our net investing activities have used up $130,000 in cash. Financing activities are mostly how we pay for this. So we could pay for this by issuing some bonds. And if we go and look at what's going on here, we have issued some bonds. Our bonds have gone from $40,000 to $90,000, so our bonds have gone up by $50,000. So we'd get the $50,000 proceeds from that bond issue, and we could use that to help pay for our investments. And then to reward our shareholders, our preferred shareholders and our common shareholders, if you look at the notes, it tells you that it was $5 a share dividend for your preferred shares. $500 or 500 shares times $5 a share is $2,500 is money we pay out, so it's money that we use. It's 100,000 shares outstanding, so it's minus 105,000. There we go. And when we add everything up together, our financing, our investing, and our operating activities, we actually generated $10,000 in cash this year. If we go to our starting balance sheet, we had a cash balance of $30,000 at the end of 2016. We add our $10,000 to it from this year, and we have a cash at the end of the year of $40,000. And that's perfect because that's the balance that we have on our second balance sheet.